Canadian mortgage debt grinds to a halt after hitting over $2 trillion. We're going to go into all of what this means for the banking system, what this means for the economy, what's happened over this super bubble, and we're going to get right into it right now. So Canadian mortgage debt grinds to a halt after hitting over $2 trillion. Just imagine for a second that kind of money. It's just an insane amount of money to even say it. Canadian mortgage credit continues to slow as rising rates grind the market to a halt. Bank of Canada data shows outstanding residential mortgage credit rose in November. However, it was one of the slowest months we've seen since 2020. Annual growth remains robust, but recent activity is bringing the trend lower. And if we go down, they have this fantastic chart which shows you how this has just essentially gone parabolic here in Canada, and you can really see the start of when this happened. So this is Canadian mortgage debt right here, and if you see right there, you can see that it really started around 2002, 2003. That was when this line just starts to go parabolic. And I would say that is really the start of this super credit bubble that Canada is in that will have disastrous consequences when it bursts, and it will burst for the reasons that I'm going to outline in this video. I've got some amazing data points. And all this is predicated on the greater fool theory. So what is the greater fool theory? Let's go to Investopedia. They tell us right there. The greater fool theory states that when you can make money from buying overvalued securities, because there will usually be someone greater fool who is willing to pay an even higher price. So it's basically just you having the mentality and belief that, hey, somebody stupider than me is going to come along and buy this overpriced asset that I just bought, so I'm going to buy it. And that is what the whole housing market is essentially predicated on in Canada. And when you think about it in the bigger picture, a lot of people say it's immigration and all these different things, when we know the immigrants aren't coming with boatloads of cash. We know this is a speculation problem. And when you have these type of reinforcing loops, it can create these super bubbles, but they always end in disaster when they're not supported by any fundamentals, but they can go on for a lot longer than normally people think. And the funny thing is, during the end phase, the very last phase, there's that blow off top, which we really saw in 2021. So I think it's incredibly important to mention that. So that's the greater fool theory. So now you know what that is, just in case you didn't know. Monthly growth showed a minor improvement, but is fairly anemic for Canada. November's growth was 0.3%, was slightly higher than October, 0.2%, but not by much. Outside of these 2 months, monthly growth hasn't been this slow since 2019. Which is really, really interesting, because with what the yield curve is saying and everything else that is happening, you know, it was looking likely that the global economy was heading into a recession anyways in 2020, regardless of what happened with the pandemic. Now, nobody could have ever seen that coming, but the yield curve inverted in 2019, and it's an important point to remember that, because the yield curve is so predictive. It's a practically 100% predictability of predicting recessions. It can't tell you exactly when the timing is gonna be, but it is it has a high degree of probability, like nearly 100%, essentially 99.9. It hasn't missed a beat yet. So it's very, very interesting. And then this shows the growth of mortgage debt. So you're talking $2 trillion here. This is a massive, massive, colossal amount of money. And when you look at Canada's actual GDP, so I've got GDP on this chart, you're talking about nearly $2 trillion. So just mortgage debt on its own, and that's US dollars, by the way, because I know the nitpickers will be out for that. But anyway, so you're talking about just mortgage debt essentially nearly being the entirety of the GDP for Canada, which is just unbelievable when you really think about that. And it just shows how we're in this massive super bubble. So if we head on over to shadow stats, I really want to show you this because this is just going to really shock you. This is going to be the most shocking thing that I think I've ever delivered on this channel. And I've done some calculations from 2003 to 2022 to illustrate to you how bad things have really got over the past 2 decades. And essentially what we have seen real wage growth adjusted for inflation using this, the 1980 CPI, not using the government's phony CPI. So this is the 1980 CPI. Do you care to guess how much the real wage growth is adjusted for this CPI? It's going to blow you away. It really is. So negative wage growth of 144.3%. So people's wages really have been affected by inflation, and not just inflation as we've seen in the past 2-3 years, although they have kind of accelerated it so much and just caused so much pain that now we've got to the end zone really quickly. But it has been compounding year after year, as you can see clearly in this chart. You know, it's been over 10%. Blue line is the 1980 CPI. CPIU, this is all US statistics, but it doesn't really matter because Canada's inflation rate essentially follows the US pretty much. The economies are tied at the hip, and the import-export business is highly integrated. So it's easy to use US statistics, and we don't have these great charts for Canada, obviously. So it's just crazy. It's unbelievable. And you can see how they follow each other. It's just the CPI, the CPIU as they call it, vastly understates inflation. Massively, in fact. You can almost double the CPIU to get the real inflation rate. So when you have that much negative wage growth, obviously that is going to have a huge impact eventually. And how have people been living for the past 10-20 years? And it's debt. You know, if we go back to this chart here, it is this. This is how they've been living. They've been living off debt, but that can't last forever. Think about it, guys. For this to last forever, people's incomes actually have to grow, because eventually you get to a point where the payments themselves for the debt are the entire amount of the person's income, or near enough, like high amounts. And you're seeing $1,000 car payments. You're seeing people, you know, paying 50% of their income towards their mortgage and different things like that. And that is the end zone, essentially, of when you get to this point when the debt payments are just so massive now, they can't be supported. And in every instance where the debt has just gone parabolic and wages haven't followed, you've had these super bubbles, you've had bubbles, and they all implode eventually. They don't last forever. And the bigger they are, the worse the pain. So it's not very good when you think of it from that perspective. And you know, we were talking about $2 trillion. You've got like 600 billion in loans to the private sector. And as we've seen here, loans to the private sector still went parabolic and is finally starting to flatline as per the data. And all these charts I've linked in the description of this video. You can explore them yourself. And another key point, if we just bring it back to inflation real quick, is if you're adjusting it for the CPI, or the CPI as I call it, then wages grew by 15.4% between 2003 and 2022. A measly 15.4%. When the actual debt, which is right here, that grew by 333%. So, I mean, clearly the debt train has just left the station well hours and hours and days and months and years before wages did. So it is just kind of insane how there is such a big spread between the two, and people they have belief systems that this can last for a long time. I mean, maybe if you're 60, 70 years old, you don't have that much to worry about. But then again, if you rely on a pension, if you rely on government transfer payments via CPP, then you're going to be massively affected by the implosion of this thing. So it's not really good at all. So consumer confidence is tanking in Canada. That's not a good sign. And just to tell you how I calculated it, I used this chart here for the hourly wages, and I backed it all the way back to 2003, took that number, and I discovered that essentially wages grew by 61.3% between 2003 and 2022. And then I adjusted that for the CPI, and I adjusted that for the 1980s CPI as well, which is not perfect. It is not perfect by any stretch of the imagination, but it's a lot closer to the real rate of inflation that we feel than the CPI. And as I've said so many times, and I really want to hammer this home in this live stream to you, is it really doesn't matter what the government tells you inflation is. The CPI, as I call it, it really is irrelevant, because it's what myself and you pay in the real world that really makes that difference, that really has that impact into the economy. Whatever they say and fabricate and say and make up about inflation is neither here or there. It's what me and you pay in the real economy that matters. And that 1980s number is closer to it, miles closer to it, than their CPI number. So anyway, if you enjoyed this video, you might like this one here. You might also like this one here. I don't know if you like the blue light, and I'm just experimenting around with the lights. Let me know what you think in the comments. Always love to chat down there. See you in the next one.